supposed to be the busiest week for IPOs, initial public offerings, since 2006. 16 companies were scheduled to go public, but 5 of them backed out at the last minute. And not even the 2 most anticipated IPOs could raise much fanfare. Karina has more on what this tells us about the IPO market.
2014's largest initial public offering so far is Ally Financial. The auto loan giant that was bailed out by the government during the financial crisis raised $2.4 billion in its IPO this week. Taxpayers made a small profit from the sale, but its shares sold lower than its expected price range.
Ally has a large amount of its business with General Motors, and there has been some negative news about General Motors and the recall.
But hotel chain La Quinta went public this week too, and also priced lower than expected. Both stocks disappointed on their first trading day. That's in sharp contrast to the beginning of the year, when 4 new public companies jumped roughly 100% on their first trading day. That's according to Kathleen Smith of Renaissance Capital, which specializes in public offerings. She says the once hot IPO market has cooled somewhat in the past few months.
Come March, the red light started to flash. The returns began to underperform the S&P 500 and have done so over the last 5 weeks or so.
What a difference from last year, when Renaissance Capital's exchange-traded fund that holds a basket of IPOs provided returns of 54%, far outpacing the S&P 500 gains for 2013. But market watchers like Richard Peterson of S&P Capital IQ says the drop in returns and pricing doesn't mean the market is headed downwards. He says the high volume of IPOs is a good sign.
Markets are in the downtrend. There are very few IPOs. Conversely, when markets are on the ascent, bankers feel it's a good opportunity to strike while the fire is so-called hot.
That may be true, but Smith says bankers are going to have to temper their expectations on pricing.
So the underwriters are going to need to adapt to a much more discerning investor right now in order to get their deals done.
Smith says investing in new public companies are the most volatile of all equity investments, so you should be prepared for wild swings. She also says you should learn as much about the company and its related business sector before committing capital. And for the retail investor, she suggests investing into an exchange-traded fund that carries a basket of IPOs to spread the risk. Karina, CCTV, New York.